Hello, friends. Today we're diving into a book that could completely change how you think about money, The Psychology of Money by Morgan Housel. Now, most people believe that building wealth is all about intelligence, strategies, and market knowledge. But this book reveals a deeper truth. Your financial success has more to do with your behavior than how smart you are. And trust me, that's a game changer. This isn't your typical finance book filled with complex jargon or boring theories. It's a collection of timeless lessons about how people think, feel, and act when it comes to money. Housel takes us beyond spreadsheets and balance sheets to explore the emotional and psychological side of wealth, how we earn it, how we keep it, and most importantly, how we lose it. What makes this book so powerful is how relatable and practical it is. You won't find a one-size-fits-all formula for getting rich. Instead, you'll discover insights that help you make better financial decisions, no matter where you are in your journey. Whether you're investing in the stock market, saving for the future, or simply trying to gain control over your money, this book offers lessons you can apply immediately. Throughout the book, Housel emphasizes a simple but profound idea. Financial success isn't just about intelligence, it's about behavior. And understanding human behavior, especially your own, is the key to building and keeping wealth. So, if you've ever wondered why some people seem to thrive financially while others struggle, this book has the answers. We're about to explore every chapter in full detail, breaking down the biggest lessons so you can apply them to your own life. And hey, if you find value in these insights, don't forget to like, share, and subscribe, because there's so much more coming your way. Let's get started. Chapter 1, No One's Crazy, from The Psychology of Money by Morgan Housel. Housel opens this chapter with a simple but powerful truth. When it comes to money, no one is actually crazy. People make decisions that might look strange or irrational from the outside, but if you dig deeper, those choices almost always make sense when you understand their life experiences. Here's the thing. Your relationship with money isn't built purely on logic or mathematical formulas. It's shaped by your personal history, what you've lived through, the lessons you've learned, and even the random events you couldn't control. This means two people can have access to the exact same financial information, but still come to completely different conclusions. Why? Because your experience with money is only a tiny slice of what's happened in the world. But to you, that slice feels like the whole picture. Housel shares a fascinating example to drive this point home. Imagine being born in 1950 versus 1970. Someone born in 1950 grew up during a period when the stock market delivered average returns of almost 7% a year. For them, investing feels like a safe and reliable path to wealth. But someone born in 1970, they experienced a very different reality. High inflation, oil crises, and a decade of flat stock market returns. To that person, the stock market doesn't feel safe at all. Same market, different experiences, leading to entirely different beliefs. And it doesn't stop there. Your view on saving, spending, and risk-taking is shaped by the economy you grew up in. If you were raised during tough times like the Great Depression, you probably developed habits of extreme caution. On the other hand, if you grew up during a booming economy, you might be more comfortable taking financial risks because you've only seen things work out. Neither approach is right or wrong. They're just different ways of responding to the world you know. Housel also points out that we often judge other people's financial choices without understanding the experiences behind them. Maybe you wonder why someone keeps all their money in cash instead of investing. But what if that person's parents lost everything in a stock market crash? For them, staying liquid feels safe, even if it's not the most rational decision, according to financial experts. Here's where it gets even more interesting. Most financial decisions aren't made in the calm, logical environment of a spreadsheet. They're made in the real world, where emotions like fear, hope, and uncertainty play a huge role. You don't save for retirement because of a perfect math formula. You do it because you're afraid of being broke when you're old. You don't buy a house just because of market conditions. You do it because you want stability for your family. And that's why no two people will ever view money the same way. Housel emphasizes that we're all playing different games with our money, and problems arise when people confuse their game with someone else's. For example, a day trader and a long-term investor are playing completely different games. The trader is focused on short-term price movements, while the investor is thinking decades ahead. So when one person says, "This stock is too risky," and another says, "This stock is a great investment," they're both right, but only in the context of their own game. This idea leads to an important takeaway. Don't assume that what works for someone else will automatically work for you. Your financial strategy should align with your personal goals, experiences, and the game you're playing. And just as importantly, be careful about judging others. What looks reckless or foolish from the outside often makes perfect sense when you understand the background behind the decision. By the end of this chapter, Housel leaves us with a profound realization. Everyone's financial behavior makes sense to them, even if it doesn't make sense to you. People's decisions about money aren't crazy. They're just a reflection of the unique experiences that shape how they see the world. And if you want to make smarter financial choices, start by understanding how your own experiences are influencing your thinking, and stay open to the idea that someone else's perspective might be just as valid as yours. In Chapter 2, Luck and Risk, Morgan Housel delivers a powerful message. Success and failure in the world of money aren't just about hard work or smart decisions. Luck and risk play a much bigger role than most people realize. And here's the key. You can't fully control either one. Housel starts by sharing a fascinating story about Bill Gates. We all know him as one of the most successful and brilliant entrepreneurs of all time. But here's something you might not know. Bill Gates went to one of the only high schools in the world that had a computer in 1968. Back then, this was almost unheard of. Out of 303 million people living in the US at the time, only about 300 teenagers had access to a high school computer, and Bill Gates was one of them. This unique opportunity allowed him to develop his programming skills years before most people even knew what computers were. Now, let's be clear. Bill Gates is undeniably smart, hardworking, and ambitious. But Housel's point is that luck, being in the right place at the right time, played a critical role in his success. If Gates had been born in a different city or attended a school without a computer, his life might have turned out very differently. But here's the twist. Just as luck can shape extraordinary success, risk can destroy even the most promising future. Housel shares another story, this time about Kent Evans, one of Bill Gates' closest friends and a fellow genius. Kent was set to have a brilliant career, just like Gates. But while still in high school, he died in a tragic mountaineering accident. The only thing that separated Bill Gates' remarkable future from Kent Evans' lost potential was random, uncontrollable risk. This leads to one of the biggest lessons of the chapter. You can't fully credit success to skill, and you can't fully blame failure on mistakes. There are always invisible forces, luck and risk, working behind the scenes. And if you don't acknowledge them, you'll misunderstand how the world of money really works. Housel emphasizes another critical point. It's easy to underestimate how much of our lives are influenced by forces beyond our control. We love simple stories that credit success to intelligence and hard work because it feels fair. But the reality is much messier. Two people can make the same decisions. One succeeds wildly and the other fails completely, just because of circumstances they couldn't predict or control. This idea is especially important when it comes to learning from successful people. We often assume that if we just copy what billionaires do, we'll get the same results. But Housel warns against this mindset. You can't separate their success from the hidden luck that played a role. What worked for them might not work for you, because the conditions that made their success possible may never happen again. And the reverse is also true. When people fail, it's tempting to blame their poor decisions, but sometimes they just got unlucky. For example, a brilliant investor could lose everything because of a sudden financial crash. That doesn't mean they were foolish. It means they faced uncontrollable risk. Housel drives home the idea that humility is crucial when thinking about money. If you succeed, don't assume you're a genius. It might just be that luck was on your side. And if you fail, don't believe you're a failure. Bad luck could be the real reason things went wrong. But here's the most practical lesson from this chapter. When you understand the power of luck and risk, you become more compassionate toward others and more cautious with your own decisions. Instead of judging people's outcomes as purely their own doing, you realize that much of life is outside their control. And for your own life, this means preparing for uncertainty, because no matter how smart or careful you are, risk is always lurking. Housel suggests adopting a balanced mindset. Work hard, be smart, and make good decisions, but never forget the role of randomness. Don't let success make you overconfident, and don't let failure break your spirit. Chapter 3, Never Enough, Morgan Housel delivers a powerful message that cuts straight to the core of why so many people struggle with money. They don't know when to stop. This chapter dives deep into the dangers of insatiable greed and why defining what enough means in your financial life is crucial for long-term happiness and security. Housel opens with a striking story about Rajat Gupta, a man who seemed to have it all. Gupta was born into poverty in India, but worked his way up to become the CEO of McKinsey & Company, one of the most prestigious consulting firms in the world. By the time he retired, he was worth over $100 million, more money than most people could ever dream of. He could have lived comfortably for the rest of his life. But that wasn't enough for Gupta. He wanted more, and that desire led him to make a critical mistake: insider trading. Hoping to climb even higher, he shared confidential information with a hedge fund manager to profit from secret corporate deals. This reckless move didn't just add a little more to his wealth, it destroyed everything. He was caught, sentenced to prison, and his reputation was ruined. Housel's point here is simple but profound. There's a danger in not knowing when to stop. No matter how much you have, if you keep chasing more without a clear definition of enough, you risk losing everything. He makes a powerful observation. The hardest financial skill is stopping once you've achieved what you truly need. Our society constantly pushes the idea that more is better. More money, more power, more possessions. But if you never draw a line and say, this is enough, you'll keep taking risks that can eventually destroy everything. Housel explains that wanting more isn't always about greed. It's often about comparison. You might feel wealthy and satisfied until you see someone else with a bigger house, a faster car, or a larger portfolio. Suddenly, what once felt like enough seems small. Comparison is the enemy of contentment. He brings up another fascinating example: Warren Buffett and Jim Simons. Both are legendary investors, but their lifestyles couldn't be more different. Buffett, despite being worth over $100 billion, still lives in the modest home he bought in 1958. He doesn't chase yachts or private islands. Why? Because he knows what's enough for him. On the other hand, Jim Simons, one of the greatest quantitative investors of all time, accumulated massive wealth by pushing the limits of financial risk-taking. But here's the catch. There's always a trade-off. The more you push for extreme wealth, the more you risk losing everything in a blink. Housel emphasizes that knowing when to stop isn't about being lazy or unambitious. It's about protecting what you've already earned. If you constantly chase more, you expose yourself to unnecessary risks. And sometimes, those risks aren't worth it. He also highlights a simple truth. Some things are priceless. Your reputation, your freedom, your relationships. These are things that no amount of money can buy back once they're gone. Rajat Gupta lost everything. Not because he needed the money, but because he didn't understand the value of enough. Housel offers a practical takeaway. Define what enough means to you personally. It's not the same for everyone. For some, it's having financial security and the freedom to spend time with family. For others, it might mean retiring early or living without debt. Whatever it is, knowing you're enough gives you the power to walk away from unnecessary risks. And here's the real wisdom. If you always want more, you'll never feel rich. No matter how much you earn, someone else will always have more. But when you decide what enough looks like, you break free from that endless chase. So, the question is, what does enough mean to you? Knowing that answer might be the most important financial decision you ever make. Chapter 4, Confounding Compounding, Morgan Housel uncovers one of the most powerful and often misunderstood forces in building wealth: compound interest. This chapter isn't just about math or finance. It's about how small, consistent gains over time can lead to extraordinary results and why so many people fail to grasp its true power. Housel starts by sharing the story of Warren Buffett, one of the world's richest men. Now, most people think Buffett's wealth is purely a result of his intelligence and investing skills. But Housel reveals a hidden truth. What makes Buffett's fortune so remarkable isn't just how he invests, it's how long he's been investing. Here's the staggering fact. Warren Buffett started investing when he was 10 years old, and by the time he was in his 30s, he was already a millionaire. But here's where it gets interesting. 99% of Buffett's net worth came after his 50th birthday. And the bulk of his $100+ billion fortune? That came after he turned 65. The reason? Compounding. Housel breaks it down simply. Compounding works like a snowball. Imagine rolling a small snowball down a hill. At first, it's tiny, but as it keeps rolling, it picks up more snow and grows larger and larger. The longer it rolls, the bigger and faster it grows. Buffett's genius wasn't just in finding good investments. It was in allowing those investments to compound for over 8 decades. Housel makes an eye-opening point. If Buffett had started investing in his 30s and retired in his 60s, no one would know his name today. It's not just how smart he is, it's how patient he's been. And this lesson applies to everyone. The magic of compounding isn't about chasing huge, flashy returns. It's about earning reasonable returns over a very long time. Even modest gains, when left to grow for decades, can turn into unimaginable wealth. Housel gives a powerful example to drive this point home. Imagine 2 people. One, person A earns 20% annual returns, but only invests for 20 years. 2, person B earns a more modest 8% annual return, but invests consistently for 60 years. At first glance, 20% sounds better, right? But over the long run, person B ends up far wealthier because their money has more time to compound. Time beats high returns. The problem is, most people underestimate how much time plays a role. We live in a world that celebrates fast success and overnight millionaires. But compounding doesn't work on a fast timeline. It works slowly, almost invisibly at first, and this slow start often discourages people from sticking with it. Housel shares a brilliant insight. The most important skill in building wealth isn't intelligence, it's patience. Many people chase the next big thing, hoping for quick riches, but those who quietly and consistently invest year after year end up building far greater fortunes. Another critical point Housel makes is that compounding isn't intuitive. It's hard for our brains to grasp exponential growth. Most of us think in linear terms. If we double something, we expect it to grow twice as big. But with compounding, each gain builds on the previous one, creating exponential growth over time. To highlight this, Housel mentions an ancient fable, the story of the king and the chessboard. A wise man asks the king for a simple reward. 1 grain of rice on the first square, 2 grains on the second, 4 on the third, and so on, doubling each time. The king agrees, thinking it's a small price to pay. But by the 64th square, the total grains of rice exceed 18 quintillion, more rice than the world could produce in centuries. That's the power of compounding. But here's where most people go wrong. They don't give compounding enough time. Impatience is the enemy of compounding. People pull their money out when the market dips, chase quick wins, or stop investing because they don't see immediate results. But compounding rewards those who wait. Housel emphasizes that the best thing you can do for your wealth isn't finding the next big thing. It's staying in the game long enough to let compounding work its magic. Consistency beats brilliance. He also touches on the importance of staying invested during tough times. Market crashes and economic downturns are part of the game. But those who stay invested through the bad times are the ones who benefit the most when things recover. The lesson of this chapter is crystal clear. Compounding doesn't work if you interrupt it. The longer you let your money grow undisturbed, the greater the rewards. In Chapter 5, Getting Wealthy versus Staying Wealthy, Morgan Housel draws a sharp distinction between how people build wealth and how they keep it. And surprisingly, these 2 skills couldn't be more different. This chapter dives deep into why getting rich often involves risk-taking, bold decisions, and optimism, while staying rich requires a very different mindset: humility, caution, and knowing when to step back. Housel begins with a simple but profound observation. There are many ways to get wealthy, but there's only one way to stay wealthy: through a combination of humility and fear. And here's the catch: what gets you rich won't necessarily keep you rich. The very traits that help people climb the financial ladder, risk-taking, confidence, and optimism, can become weaknesses if they don't adjust their mindset once they've accumulated wealth. He shares a powerful example from the financial world: Jesse Livermore, one of the greatest stock traders of the early 20th century. Livermore was famous for making the equivalent of billions of dollars by correctly predicting the 1929 stock market crash. He had everything: money, fame, and power. But despite his brilliance, he lost it all. Why? Because he couldn't stop taking risks. The same bold moves that made him rich eventually destroyed his fortune. Housel points out that luck plays a bigger role in getting rich than most people want to admit. And that's where humility comes in. You can make all the right moves, but if luck turns against you, it can wipe everything out. The key to staying wealthy is understanding this. You're never as invincible as you think. A crucial lesson here is that survival is the foundation of long-term wealth. You don't need to be a genius or have the highest returns. You just need to avoid catastrophic losses. Housel emphasizes that getting rich requires optimism, believing things will work out. But staying rich requires paranoia, accepting that bad things will happen and preparing for them. He uses a great analogy to explain this. Imagine you're climbing a mountain. Getting to the top requires courage and drive. But staying on top means avoiding risky moves that could send you tumbling down. Survival is everything. One of the most powerful ideas in this chapter is that wealth is like a delicate house of cards. It takes years to build, but can collapse in an instant. That's why people who stay wealthy focus on defense, not just offense. They don't chase the highest returns. They prioritize not losing what they already have. Housel highlights a fascinating insight. You only need to get rich once. Once you've built your wealth, taking unnecessary risks can undo everything. Many people get trapped in the mindset of always wanting more, but this greed can lead to reckless decisions that destroy years of progress. He also shares a key psychological truth. Being financially unbreakable is more important than being outrageously wealthy. Why? Because the longer you stay in the game, the better your chances of long-term success. It's not about hitting home runs. It's about avoiding strikeouts that could knock you out of the game entirely. Another important takeaway is the value of frugality and humility. Housel explains that wealth is what you don't see. It's the unspent money sitting quietly in your bank account, not the flashy cars or luxury lifestyle. People who stay rich understand this. They live below their means and never let their ego push them into risky situations. He also touches on the power of margin of safety, building a cushion in your finances so that unexpected shocks don't destroy you. Whether it's having extra cash on hand, investing conservatively, or preparing for the worst, being cautious isn't boring, it's smart. Housel brings the chapter to a simple but powerful conclusion. Getting rich is about being bold, but staying rich is about being humble. If you can balance both, the willingness to take risks when needed and the humility to protect what you've earned, you set yourself up for long-term success. In Chapter 6, Tails You Win, Morgan Housel reveals a fascinating truth about success. A small number of events often account for the majority of outcomes. This concept, known as tail events, applies not only to investing but also to life itself. And understanding how these rare, extreme outcomes shape the world is crucial if you want to succeed financially. Housel starts by explaining what tail events are. In simple terms, they're outliers, rare events that have a massive impact. Most things in life follow a normal distribution, small, predictable changes. But in finance, a few extraordinary outcomes drive the majority of returns. Just a handful of big wins can account for almost all the success. To bring this idea to life, Housel points to the stock market. Over the last century, just a tiny fraction of stocks have created most of the market's total returns. Think about that. A small handful of companies, like Apple, Amazon, and Microsoft, are responsible for the bulk of wealth creation. Without these outliers, the overall market would look average or even disappointing. He shares a striking example. Between 1980 and 2010, 40% of all US stocks lost money. But the market as a whole still grew because a small group of big winners pulled the average way up. That's the power of tail events. They offset the losers and push overall success higher. And here's the twist. You can't predict which tail events will happen. No one knew Amazon would become a trillion-dollar company when Jeff Bezos was shipping books from his garage. The lesson? You don't need to be right all the time. You just need to be right once in a big way. Housel emphasizes that most of your investments won't be home runs, and that's perfectly okay. A few massive wins can make up for many small losses. That's why patient, long-term investing works. You stick around long enough to catch those rare, transformative events. He also shares a surprising truth about Warren Buffett. Despite his incredible success, the majority of Buffett's wealth comes from just a few smart investments. Companies like Coca-Cola and American Express are his tail events, and without them, he wouldn't be the billionaire we know today. But here's where people go wrong. Most investors give up too soon. When they see small losses or underwhelming gains, they panic and sell. What they don't realize is that patience is the price you pay to capture those rare tail events. If you're too quick to exit, you miss the big wins. Housel gives another real-world example, venture capital. In this world, most startups fail. But investors aren't looking for small wins. They're searching for the next Facebook or Google. One massive success can pay for dozens of failures. That's the power of tails. You don't need everything to work. You just need a few things to work spectacularly. And it's not just about money. This principle applies everywhere. Think about science. Most experiments fail, but a few breakthroughs change the world. In entertainment, most movies lose money, but a blockbuster like Avengers can make billions. Tail events are everywhere. They shape technology, history, and human progress. Housel makes a critical point. Embracing tail events requires a shift in mindset. Instead of trying to avoid small losses or predict every move, you focus on staying in the game long enough to capture the outliers. This means accepting some failures and understanding that big wins will come, but on their own unpredictable timeline. He also emphasizes the importance of diversification. Since you can't know which investments will become tail events, spread your bets. By holding a wide range of assets, you increase your chances of catching a life-changing winner. And here's a lesson most people overlook. It's okay to be wrong most of the time. In fact, Housel argues that being wrong often is part of the process. The goal isn't perfection, it's endurance. As long as you're in the game, you have a shot at hitting a tail event that changes everything. Toward the end of the chapter, Housel delivers a simple but profound insight. In investing, you don't need to win constantly. You just need to win big occasionally. Most people chase small, consistent gains and miss the fact that a few rare, unpredictable successes drive real wealth. In Chapter 7, Freedom, Morgan Housel makes a bold claim. The highest form of wealth isn't a fancy car, a big house, or millions in the bank. It's freedom, the ability to control your time and make decisions independently. This chapter dives deep into why having control over your own life is the most valuable form of wealth and why so many people overlook it. Housel starts by highlighting a simple truth. People want to be in control of their lives. If you ask someone why they want to be rich, they might mention luxury, status, or comfort. But if you dig deeper, the real reason is freedom. People want the ability to wake up and decide what to do with their day, without answering to a boss, meeting deadlines, or stressing over bills. He explains that money itself isn't the goal. Freedom is. What people truly crave is the ability to live on their own terms. Think about it. What's the point of having millions if you're chained to a job you hate or constantly stressed out? True wealth means having control over your time, the most limited and precious resource we have. Housel backs this up with a powerful statistic. More people value time freedom over high incomes. Studies consistently show that people who feel in control of their schedules report higher levels of happiness, regardless of how much they earn. It's not the paycheck that brings fulfillment. It's the ability to say, I choose how to spend my time. He also points out a paradox. Many wealthy people aren't actually free. They might have millions, but they're trapped in demanding jobs, endless responsibilities, and social expectations. True wealth isn't just about making money. It's about having the freedom to walk away. Housel shares a fascinating example. A doctor earning $500,000 a year, but working 80-hour weeks, constantly on call. Despite the huge salary, they have no time for their family or personal interests. Meanwhile, someone earning far less, but who controls their time, might feel wealthier because they're living life on their own terms. A crucial point he makes is that freedom compounds just like money. The earlier you prioritize time independence, the more it grows. If you design your life around having flexibility, whether through investing, saving, or reducing unnecessary commitments, you start to experience the power of freedom. And this freedom expands, giving you more control as time goes on. He also tackles a big misconception. More money doesn't automatically mean more freedom. In fact, chasing bigger paychecks often comes with more responsibilities, tighter schedules, and less control. True financial independence means earning enough to cover your needs while preserving your ability to decide how you live. Housel explains that one of the smartest financial moves is to buy your freedom, not with luxury, but with autonomy. This means focusing on saving money, avoiding unnecessary debts, and building a financial cushion that allows you to make choices without fear. The real power of money isn't in what it buys, it's in the options it gives you. He shares another thought-provoking insight. Time is the only asset you can't get back. You can lose money and earn it again, but once time is gone, it's gone forever. That's why freedom, the ability to control your time, is the ultimate form of wealth. The most successful people aren't the ones with the most stuff. They're the ones who wake up every day and decide what to do with their time. Housel also emphasizes that you don't need to be a millionaire to achieve freedom. Small, intentional decisions, saving consistently, avoiding lifestyle inflation, and living below your means, can give you control over your life. It's not about how much you earn, it's about how much freedom you protect. He gives an example of a man who retired early, not because he was extraordinarily wealthy, but because he prioritized freedom over luxury. By saving aggressively and avoiding unnecessary expenses, he bought back his time. Now, instead of being stuck in a job, he spends his days doing what matters to him. And that's true wealth. A powerful takeaway from this chapter is that freedom isn't just a financial goal, it's a life philosophy. If you organize your financial decisions around gaining more control over your time, you'll experience a deeper sense of satisfaction. It's not about how much you have, it's about whether you can choose how to live. Housel ends with a profound truth. Money gives you the ability to say no. And that's what freedom is really about. The power to say no to a job you hate, to people who drain your energy, or to obligations that don't align with your values. When you have enough to choose your own path, you've already won. In Chapter 8, The Man in the Car Paradox, Morgan Housel reveals a fascinating truth about how people view wealth and status. At its core, this chapter dives into the paradox that while people chase wealth to earn admiration, the reality is that money often doesn't bring the respect they expect. It's a powerful reminder that what we think wealth signals to others isn't always what they actually see. Housel begins by describing a familiar scene. You see a man driving a luxury car. Most people, when they spot a sleek sports car or a high-end vehicle, might think, wow, that car is amazing. But here's the twist. They rarely think about the driver. People admire the car, not the person driving it. The paradox is that while the owner may have bought the car to showcase his success, most observers aren't thinking about him at all. They're imagining themselves behind the wheel. And that's the heart of the paradox. People don't admire you as much as they admire the lifestyle you represent. When someone buys luxury items to impress others, the attention usually falls on the item, not the person. This contradiction means that people often chase wealth for admiration, but end up being overlooked in the process. Housel shares an important insight. When you see someone with something impressive, you're more likely to think about having it for yourself than to admire the person who owns it. Think about it. When you see someone in a luxury car, are you thinking about how amazing their life is, or are you imagining how it would feel to drive that car yourself? That's the paradox. Wealth is supposed to elevate you in others' eyes, but instead, it often just highlights what people want for themselves. This leads to a powerful conclusion. Trying to earn respect through material possessions is a losing game. If your goal is to be admired, buying flashy things might not work the way you think. People care more about how that wealth could improve their own lives than they do about who actually owns the stuff. Housel points out another key truth. Real admiration comes from who you are, not what you own. People who are respected the most aren't those flaunting wealth. Instead, they're admired for their kindness, humility, work ethic, or wisdom. These are the qualities that stick. Material possessions may turn heads temporarily, but true character earns lasting respect. He also discusses how insecurity fuels this paradox. Many people buy expensive things because they feel a need to prove their worth, but the irony is that the more they try to impress others, the less people actually care. It's easy to assume that showing off wealth will gain admiration, but most people are too focused on their own desires to care deeply about someone else's success. Housel brings up a compelling example. You might see someone with a $100,000 watch and think, that's a nice watch. But do you immediately admire their personality? Probably not. You admire the object, not the owner. And yet, so many people spend their lives chasing external symbols of success, hoping to win admiration, while missing the fact that people value inner qualities far more. A striking takeaway from this chapter is this. If you want to be respected, focus on who you are, not what you own. Wealth can enhance your life, but it can't buy the kind of admiration that lasts. People remember how you treat them, not how expensive your car is. Housel also emphasizes that the desire to impress others is a common human trait. But if you understand this paradox, you can step off the treadmill of consumerism. Instead of spending money to earn fleeting admiration, you can invest in building a life of purpose and authenticity. He suggests a smarter approach. Use money to gain freedom and security, not to impress others. The people who matter most will value you for your character, not your possessions. True wealth isn't about being seen. It's about living on your own terms and being comfortable with who you are. In Chapter 9, Wealth is What You Don't See, Morgan Housel reveals a surprising truth about wealth. Real wealth is invisible. It's not the flashy cars, the designer clothes, or the luxury vacations. Instead, true wealth is what you don't spend. It's the money sitting quietly in your bank account, the investments growing behind the scenes, and the financial security you build over time. Housel starts by pointing out a simple but profound idea. When you see someone driving an expensive car, you're only seeing what they chose to spend their money on, not what they saved. And that's the catch. Wealth isn't about what you see, it's about what's hidden. A person may appear rich because of their lifestyle, but that doesn't mean they actually are. Real wealth is unspent money, the freedom and options it gives you. He shares an important distinction between being rich and being wealthy. Being rich is about spending. It's visible. You can see a person's wealth when they're driving a luxury car or living in a mansion. But being wealthy is about saving. It's what's invisible. It's the ability to maintain your lifestyle without working, having financial security, and the freedom to make choices on your terms. Here's the twist. The more someone spends to show off wealth, the less wealth they actually have. If you see someone flaunting expensive things, what you're really seeing is what they've chosen not to save. This means that true wealth is what you never notice. It's the assets quietly compounding over time, the money set aside for the future, and the security that lets you live without fear. Housel explains that one reason people misunderstand wealth is because society glorifies consumption. We admire people with big houses and fancy cars because that's what's visible. But we don't see the years of disciplined saving or smart investing that actually creates long-term wealth. It's easy to assume someone is wealthy when they spend a lot, but in reality, spending often reflects the absence of wealth. He shares a powerful insight. Spending money to show others how much you have is the fastest way to lose it. Many people fall into this trap. They earn more, and instead of saving, they increase their lifestyle. This is called lifestyle inflation. As income rises, so do expenses. And if you're spending everything you earn, you're not building wealth. You're just maintaining the illusion of it. Housel introduces a crucial mindset shift. Wealth is not about what you earn, but about what you keep. Even high earners can struggle financially if they don't save and invest wisely. True wealth grows silently. It's the unseen financial cushion that gives you the ability to make decisions without being controlled by money. He highlights that financial freedom comes from understanding this principle. Wealth isn't the things you show. It's the flexibility to live life on your terms. It's the ability to take risks, to walk away from a job you don't like, or to retire comfortably. The real reward of wealth isn't impressing others. It's having the power to choose how you live. Housel also touches on why people chase visible wealth. It's driven by status and social validation. Many people want to be perceived as successful, so they spend money on things that project that image. But here's the irony. The wealthiest people are often the least flashy. They understand that money quietly working for you is far more valuable than impressing strangers. He shares an example of Ronald Reed, a janitor who lived a modest life but secretly accumulated $8 million through patient saving and investing. No one ever suspected he was wealthy because he didn't flaunt his money. This story is a perfect reminder that wealth is often hidden in plain sight. Housel emphasizes a key takeaway. The most valuable things money can buy aren't material. It's the freedom to control your time, to reduce stress, and to live without constantly worrying about the next paycheck. True wealth isn't about showing off. It's about having the peace of mind that comes from financial independence. In Chapter 10, Save Money, Morgan Housel breaks down a simple but life-changing truth. Saving money is the most powerful tool to gain control over your life. It's not just about accumulating wealth. It's about creating freedom, flexibility, and peace of mind. And here's the thing. You don't need a specific reason to save. Just having savings gives you options when life throws unexpected challenges your way. Housel emphasizes that building wealth doesn't always require earning a massive income. In fact, he points out that how much you save is more important than how much you earn. Why? Because savings are the gap between your ego and your income. When you resist the temptation to spend just to impress others, you open the door to long-term financial security. Saving money isn't just a financial habit, it's a lifestyle choice rooted in humility and patience. One of the biggest lessons in this chapter is that saving gives you freedom. When you have money set aside, you're not trapped in a job you hate or stuck in situations you can't escape. Savings buy you time and flexibility. If you want to take a break, start a new business, or handle a family emergency, your savings give you the power to make those decisions on your terms. And here's the key. Freedom is the ultimate form of wealth. Housel explains that people often underestimate the value of saving because it doesn't feel as exciting as spending. A new car or a luxury vacation gives you an immediate dopamine hit. But savings work quietly in the background, building long-term security. The people who save consistently understand that wealth is what you don't see. They know that real financial power comes from having resources when you need them, not from flashy displays of spending. He also points out a common mistake. People often wait until they have a specific goal to start saving. But the truth is, you don't always know what the future holds. Unexpected things happen. Medical bills, job loss, economic downturns, and having savings gives you a safety net. You don't need to justify every dollar you save. Save because life is unpredictable. A powerful point Housel makes is that saving isn't about being frugal for the sake of it. It's about having control. When you save money, you're buying yourself the ability to make better choices. You're not forced to stay in a toxic job because you need the paycheck. You're not stuck living paycheck to paycheck, constantly worrying about the next bill. Saving gives you the power to walk away, pivot, and live on your terms. And here's an eye-opening truth. You don't need to be a financial genius to save. You don't have to master complex investment strategies. Just spend less than you earn and consistently save the difference. This simple habit is more effective than chasing risky investments or hoping for a lucky break. Housel highlights a crucial mindset shift. Saving money isn't about depriving yourself. It's about expanding your possibilities. Every dollar you save buys you a little more independence, and that independence compounds over time, just like interest on your investments. The more you save, the more freedom you gain. He shares a key observation. Your ability to save is driven more by your behavior than your income. Plenty of people with high salaries struggle financially because they spend everything they earn. On the flip side, people with modest incomes who consistently save can build incredible wealth over time. It's not about how much you make, it's about how much you keep. Another point he emphasizes is avoiding lifestyle inflation. As people earn more, they often increase their spending to match. This traps them in a cycle where no matter how much they earn, it's never enough. But if you maintain a reasonable lifestyle while increasing your savings, you'll break free from that cycle and build true financial security. Housel also discusses the emotional benefits of saving. When you have a financial cushion, your stress levels drop. You're not constantly worried about the next emergency. You sleep better at night knowing you have a backup plan. This peace of mind is priceless. It allows you to focus on living a meaningful life instead of constantly chasing the next paycheck. He wraps up this chapter with a clear message. Saving money is one of the most empowering things you can do. It's not just about becoming rich, it's about giving yourself options, freedom, and security. In Chapter 11, Reasonable Rational, Morgan Housel makes a powerful argument. When it comes to money, being reasonable is often better than being perfectly rational. Now, this might sound counterintuitive because most financial advice tells us to be logical, data-driven, and always optimize for the best outcome. But Housel explains that real-life decisions about money are emotional, personal, and shaped by individual experiences. And sometimes the rational choice on paper isn't the best choice for your mental well-being or long-term happiness. He starts by highlighting a crucial point. People aren't robots. We don't make decisions purely based on numbers and spreadsheets. We have emotions, fears, and goals that can't always be captured by cold, rational logic. Housel argues that a financial plan that works in theory won't work in practice if it doesn't fit your personality and comfort level. For example, from a purely rational standpoint, you might think investing all your money in the stock market is the best way to maximize returns over time. Historically, the market goes up in the long run. But here's the reality. Most people can't emotionally handle the wild swings of the stock market. Watching your investments drop by 30% during a crash isn't just a financial event. It's an emotional roller coaster. And if those losses cause you to panic and sell at the worst possible time, then the rational strategy ends up being a disaster. This is why Housel emphasizes that a reasonable strategy, one you can stick with through thick and thin, is better than a perfectly optimized but emotionally unsustainable one. He shares a fascinating example about holding cash. Rationally, cash loses value over time due to inflation. Any financial advisor would tell you to invest it instead. But for many people, having a cash cushion brings a sense of security and reduces anxiety. And that peace of mind is priceless. So, even though holding cash might not be the rational choice, it's often the reasonable one, especially if it helps you sleep better at night. Housel also dives into why people make different financial choices based on their unique experiences. Someone who grew up during a financial crisis may prioritize saving and avoiding debt because they've seen how quickly things can fall apart. On the other hand, someone raised in a booming economy might be more comfortable taking risks because they've only known growth and stability. Neither approach is right or wrong. It's about what feels reasonable to the individual. A key takeaway from this chapter is that personal finance is more personal than it is finance. The best plan isn't the one that looks perfect on paper. It's the one you can stick with for decades. Whether it's choosing to pay off your mortgage early for peace of mind or keeping more cash than financial models recommend, if a strategy helps you feel secure and stay the course, it's a winning strategy. Housel also touches on the psychological side of money decisions. He points out that people want to feel like they're in control. And often, the most rational decision doesn't give that feeling. For instance, mathematically, it might make sense to invest every spare dollar. But emotionally, many people find comfort in paying off debt, even if it's not the highest return on investment. He uses a simple but profound example. Why do people buy lottery tickets? Rationally, the odds are terrible. But people don't buy lottery tickets because it makes financial sense. They buy them because for a few dollars, they're purchasing hope and the chance to dream of a better life. It's not rational, but it's deeply human. Another point he raises is that consistency matters more than perfection. A reasonable plan you can stick with for 30 years will outperform a rational plan you abandon during tough times. The best investment strategy isn't the one with the highest returns. It's the one you can follow without losing your sanity. Housel suggests that understanding your emotional triggers and building a plan around them is smarter than forcing yourself into a rigid, rational framework. For example, if you know you panic during market crashes, it's reasonable to keep a chunk of your wealth in safer assets, even if it's not the most rational decision. That buffer gives you the confidence to stay invested without freaking out when the market dips. He also warns against comparing yourself to others. What's reasonable for you may not be reasonable for someone else. If your neighbor takes huge risks and gets lucky, it doesn't mean you should do the same. Your financial plan should reflect your goals, values, and emotional comfort, not someone else's highlight reel. Throughout this chapter, Housel drives home the idea that money is not just math, it's psychology. And recognizing the emotional side of financial decisions is key to building a plan that works for the long haul. Being reasonable may not always give you the highest returns, but it will keep you on track when others are losing their way. In Chapter 12, Surprise, Morgan Housel emphasizes a powerful truth. The biggest financial events in history are always the most unexpected. No matter how much data we analyze or how carefully we plan, the world has a way of surprising us. And when it comes to money, these surprises can change everything. Housel opens the chapter by explaining that the most important events in finance, the ones that shape economies, markets, and personal wealth, are usually the ones no one saw coming. Think about it. No one predicted the exact timing or scale of events like the 2008 financial crisis or the COVID-19 market crash. Yet these surprises had a massive impact on people's financial lives. One striking example he gives is from World War II. Before the war, no one could have imagined the level of global transformation that would follow: economic booms, technological advancements, and the rise of new world powers. Yet these unforeseen changes shaped the modern financial landscape. Housel explains that we often rely on historical data to predict the future, assuming that past trends will continue. But the truth is, the future is always a mix of what we expect and what we never imagined. He makes a crucial point. The biggest risks and the biggest opportunities are always things we don't see coming. Here's the challenge. If we only prepare for the things we expect, we'll always be caught off guard by the things we don't. This is why rigid financial plans, ones that assume the future will follow a neat, predictable path, often fail when reality throws a curveball. Housel highlights that most of what happens in the world is the result of things that hadn't happened before. For instance, nobody in the 1990s predicted that the internet would completely transform the global economy. Similarly, no one could have anticipated how a virus in 2020 would shut down entire countries and trigger an economic shockwave. Surprises like these redefine what's normal. He also points out that experts often get it wrong, not because they're unintelligent, but because the future is fundamentally unpredictable. Even the most brilliant economists and investors can't foresee the next big surprise. And ironically, the more confident someone is about their predictions, the more likely they are to be blindsided. Housel brings in a fascinating insight about how we interpret history. When we look back, everything seems inevitable. The causes and effects feel obvious, but that's an illusion. In the moment, people had no idea what was coming next. This hindsight bias tricks us into believing the world is more predictable than it actually is. He uses a clear example to drive this home. Consider how people viewed the 2008 financial crisis after it happened. In retrospect, it seems obvious. Housing prices were soaring unsustainably, banks were overleveraged, and risk was piling up. But at the time, very few people truly believed the entire financial system was on the verge of collapse. The surprise factor made the crisis so devastating. This leads to an important takeaway. The key to surviving and thriving in the financial world isn't about perfectly predicting the future. It's about building a plan that can handle surprises. You need to be adaptable. One of the smartest ways to do this, Housel suggests, is to leave room for error. Instead of betting everything on a single outcome, create flexibility in your financial decisions. For instance, having a cash cushion or a diversified portfolio gives you the ability to weather unexpected storms. He gives a powerful analogy. Imagine driving a car. If you always drive right on the edge of the road, the tiniest mistake could send you crashing. But if you leave a bit of space, a margin of safety, you're far more likely to stay on track when surprises pop up. Housel also emphasizes the importance of humility in the face of uncertainty. People often chase the highest returns, believing they can predict the next big thing. But those who succeed over the long run understand that they don't know everything. They build financial plans that are resilient, not just optimistic. Another insight he shares is that adapting to surprises is more valuable than trying to predict them. Instead of focusing all your energy on forecasting the future, focus on preparing for the unknown. This means having emergency savings, avoiding excessive debt, and making decisions that offer flexibility rather than locking yourself into rigid paths. Housel also challenges the notion that markets are perfectly rational. Financial markets are made up of people, and people are emotional, unpredictable, and often driven by fear and greed. So, even if you think you understand how things should work, surprises can flip everything upside down. He concludes with a profound idea. The world will keep surprising us. No matter how much we analyze, plan, or prepare, there will always be events beyond our imagination. The people who succeed financially aren't the ones who predict every twist and turn. They're the ones who expect surprises and build their lives around the reality of uncertainty. Chapter 13, Room for Error, Morgan Housel delivers a crucial message. The most successful financial plans aren't the ones that are perfect, but the ones that leave room for mistakes and uncertainty. This chapter is all about understanding that no matter how smart or prepared you are, life will always throw surprises your way. And the only way to stay financially secure is by building a margin of safety into everything you do. Housel begins by explaining that when it comes to money, things rarely go exactly as planned. Even the best forecasts can be wrong because the world is unpredictable. Whether it's a market crash, a job loss, or a personal emergency, unexpected events are a part of life. And if your financial plan doesn't leave room for these surprises, you're setting yourself up for failure. He makes a powerful point. You don't need to be right all the time to succeed. What you really need is the ability to survive when you're wrong. This is where the concept of room for error comes in. It's about building a cushion into your financial life so that even when things go sideways, you can stay afloat. One key example Housel gives is from the world of investing. Imagine you expect the stock market to grow at 8% per year. If your entire plan depends on hitting that exact number, you're vulnerable to disappointment. Why? Because markets are unpredictable. They could return 12% one year and lose 20% the next. If you've left no margin for error, a bad year could destroy your plans. But if you assume a more conservative growth rate, say 4%, you're building a safety net into your strategy. If the market does better, great. But if it underperforms, you're still covered. This cushion protects you from unexpected downturns. Housel points out that room for error isn't just about numbers. It's about mindset. Many people take on too much risk because they're confident everything will go according to plan. But life doesn't work that way. Humility is essential. You need to accept that you can't predict everything and prepare accordingly. A fascinating example Housel shares comes from World War II. During the war, engineers built redundancy into their airplane designs, meaning if one engine failed, the others could still keep the plane flying. This extra layer of safety saved countless lives. The same principle applies to your finances. Having a margin of error allows you to stay in the game when things go wrong. He also touches on the difference between being optimistic and being realistic. It's easy to believe that the future will always be bright, but smart financial planning requires recognizing that bad things happen. And when they do, you want to be ready. One of the most practical ways to create room for error is by saving more than you think you need. Many people save just enough to cover expected expenses, but this leaves no cushion for surprises. Having extra savings gives you the freedom to navigate life's uncertainties without panicking. Housel emphasizes that over-optimizing can be dangerous. When people try to squeeze every bit of return from their investments or stretch their budgets to the limit, they leave themselves exposed to risk. A little inefficiency is actually a good thing. It provides a buffer against the unknown. He gives the example of Warren Buffett. Despite his legendary investing skills, Buffett always keeps a significant amount of cash on hand. Why? Because he knows that the future is uncertain. This cash reserve gives him the flexibility to seize opportunities or weather downturns without being forced to sell his investments. Another key point is planning for the unexpected. Whether it's a medical emergency, a job loss, or a global crisis, life's biggest challenges are usually the ones you didn't see coming. By leaving room for error, you're not just protecting yourself, you're giving yourself the ability to stay calm and make better decisions under pressure. Housel also explains that margin for error isn't about pessimism, it's about resilience. It's not about assuming everything will go wrong, but recognizing that things might not always go right. This mindset allows you to take risks without jeopardizing your future. He compares financial planning to crossing a bridge. If the bridge can hold exactly the weight of your car, any extra load could cause it to collapse. But if the bridge is built with a safety margin, designed to hold several times more weight, you can cross with confidence. Your financial plan should be the same. Housel closes the chapter with a simple but profound idea. You can only stick to a plan if it can survive reality. And reality is messy, unpredictable, and full of surprises. By building room for error, you give yourself the best chance to not just survive, but thrive in a world where the unexpected is inevitable. Chapter 14, You'll Change, Morgan Housel dives into a reality many people overlook. You are not the same person you were a few years ago, and you won't be the same person a few years from now. Your goals, values, and desires evolve over time, and this shift directly impacts your financial decisions. Housel starts by pointing out something simple but profound. Most people underestimate how much they will change in the future. It's easy to assume that the things you care about today will always matter to you. But the truth is, your future self will probably want different things than your present self. He introduces the idea of the end of history illusion. This is a psychological concept where people believe that while they've changed a lot in the past, they won't change much in the future. But research shows that people's personalities, values, and ambitions continue to evolve throughout their lives. Housel uses a relatable example. Think about the person you were 10 years ago. What did you care about? What did you want? Chances are, many of those priorities have shifted. Now imagine yourself 10 years from today. You'll probably view life differently than you do now. This simple truth has huge implications for how you handle money. One key takeaway is that long-term financial decisions are hard because you're making choices for a future version of yourself that you don't fully understand yet. For example, you might work 80-hour weeks today to chase a career goal, but in 20 years, you might prioritize time with your family over a bigger paycheck. The problem? You're making decisions today based on values that may not last. Housel gives an example from his own life. When he was younger, he dreamed of owning a fancy sports car. But by the time he could afford it, he no longer wanted one. What seemed important when he was 20 felt meaningless at 30. This shift isn't unique. Everyone goes through it. He emphasizes that one of the biggest financial risks is locking yourself into decisions that assume your desires won't change. This is why he advises against making irreversible financial commitments based on what you want today. Whether it's an expensive home, a specific career path, or a long-term investment, you need to leave room for your future self to evolve. A powerful point Housel makes is that flexibility is worth more than precision. Many people obsess over making the perfect financial plan. But if that plan assumes your values will never change, it's bound to fail. Instead, it's smarter to build a financial life that allows you to adapt as your priorities shift. He also touches on why people struggle to let go of past decisions. Once we invest time, money, or energy into something, it's hard to walk away, even when our desires change. This is known as the sunk cost fallacy. For instance, if you spend years climbing the corporate ladder, it's tough to admit that you no longer want to be there. But staying stuck in old decisions can lead to regret. Housel argues that freedom to change is the ultimate financial luxury. It's not just about having money, it's about having the ability to pivot when your values shift. This means keeping your financial commitments flexible, avoiding too much debt, and saving more than you think you'll need. He shares a compelling insight. Many people save money not just for the things they want, but for the freedom to change their minds. You may not know what future you will care about, but by saving aggressively and avoiding rigid commitments, you're giving yourself the ability to choose a different path later. A practical example Housel gives is about career choices. Imagine you spend your 20s chasing a high-paying job in finance. It feels fulfilling now, but by your 40s, you might crave more time with your family or want to pursue a creative passion. If your financial plan assumes you'll always want to work at the same intensity, you could find yourself trapped. But if you've built savings and flexibility into your life, you have the option to step back when your priorities shift. Housel also emphasizes that acknowledging change doesn't mean you're indecisive. It means you're realistic. Life isn't static. Your goals, ambitions, and values will evolve, and a smart financial plan leaves room for those shifts. Another powerful point he makes is that not all change is predictable. You might think you know what you want in 5 or 10 years, but life's biggest shifts often come as surprises. Whether it's a new relationship, a health issue, or a global event, the future is filled with unknowns. Planning for change means preparing for what you can't foresee. He encourages readers to prioritize options over certainty. Instead of locking yourself into a rigid plan, aim to build a life with room for flexibility. This means maintaining a cash cushion, staying out of unnecessary debt, and choosing careers and investments that allow you to pivot. Housel ends with a simple but profound reminder. You are a work in progress, and your financial plan should reflect that. The smartest strategy isn't about chasing an unchanging dream. It's about building a system that allows you to adapt as your dreams evolve. In Chapter 15, Nothing's Free, Morgan Housel breaks down a simple but powerful truth. Everything in life comes with a price, even if you don't see it right away. When it comes to money, success isn't free. There's always a cost, whether it's visible like a price tag or hidden in the form of emotional or mental stress. And understanding this is key to making smarter financial decisions. Housel starts by challenging a common misconception. People often believe they can achieve financial success without paying a price. But the reality is, every reward in life comes with a trade-off. You can't earn big returns in the stock market without enduring volatility. You can't build wealth without sacrificing comfort today. And you can't enjoy financial freedom without the discipline to save. One of the most important ideas in this chapter is that volatility is the price of admission for successful investing. Many people think market ups and downs are an unnecessary burden or a sign that something is wrong. But Housel argues that volatility isn't a punishment, it's the fee you pay to enjoy long-term gains. He compares this to buying a ticket to a theme park. If you want to ride the roller coaster, you have to pay for the ticket. In the same way, if you want the rewards of investing, growth, compounding, and wealth, you have to accept the emotional price of dealing with uncertainty and risk. Housel emphasizes that this price is unavoidable. You can't eliminate market swings, and you can't time the market perfectly. The only way to succeed is to accept the discomfort as part of the deal. But the problem is, most people want the reward without paying the price. They want consistent returns without risk, which is simply impossible. He makes a critical distinction. The price of success isn't always obvious up front. Unlike a price tag on a product, the costs of financial success, stress, uncertainty, and patience are often hidden. And because they're invisible, people underestimate them or try to avoid them altogether. Housel shares a powerful example from Warren Buffett's life. Despite being one of the world's most successful investors, Buffett's wealth came with a price: decades of enduring market crashes, criticism, and uncertainty. Many people admire his fortune, but overlook the emotional and psychological cost he paid along the way. Another key point Housel makes is that understanding the true cost of wealth makes it easier to stay the course. If you view market volatility as a penalty, you'll want to avoid it. But if you see it as the entry fee for long-term returns, you'll be more willing to endure the rough patches. He also touches on the importance of reframing your mindset. Instead of feeling frustrated by market drops or economic uncertainty, recognize that this is the cost you're paying for financial freedom. Just like paying rent keeps a roof over your head, accepting volatility keeps your investments growing. A fascinating insight Housel provides is that many people give up on investing because they refuse to accept the fee. When the market crashes or their portfolios lose value, they panic and sell. But those who understand that this discomfort is the price of long-term wealth are the ones who stay invested and ultimately succeed. He also argues that trying to avoid the price often leads to bigger mistakes. For example, some investors jump from one strategy to another, hoping to find a way to make money without risk. But in doing so, they often miss out on the compounding benefits of staying consistent. In the pursuit of avoiding pain, they end up paying an even higher price: lost returns and missed opportunities. Housel highlights that every financial decision involves a trade-off. If you want safety, you'll give up potential returns. If you want high returns, you'll face more volatility. If you want freedom, you need discipline. Understanding these trade-offs helps you make smarter, more patient decisions. He also emphasizes you get to choose which price you pay. You can either pay the price of staying invested through tough times, or you'll pay the price of missing out on the wealth-building power of compounding. But there's no escaping the fact that you'll pay something either way. A powerful takeaway from this chapter is that people who succeed financially aren't necessarily smarter or luckier. They're simply better at accepting and paying the price. They don't try to avoid discomfort. Instead, they embrace it as the cost of achieving their goals. Housel also addresses the emotional toll of financial decisions. It's not just about numbers, it's about how those numbers make you feel. When you invest, you're not just dealing with market data. You're managing your fears, hopes, and anxieties. And this emotional price is one of the hardest to pay. To make his point even clearer, Housel compares it to exercise. If you want to be fit, you can't avoid the pain of working out. The soreness isn't a sign something's wrong. It's proof that you're making progress. The same is true for money. The ups and downs aren't flaws in the system. They're signs that you're on the path to long-term wealth. One of his final insights is that understanding this concept helps you stick with your plan. If you expect the journey to be smooth, every bump feels like a failure. But if you know in advance that volatility and uncertainty are part of the deal, you're more likely to stay the course when things get tough. Chapter 16, You and Me, Morgan Housel dives deep into how personal experiences and individual biases shape our financial decisions, and why this leads to vastly different money behaviors between people. At the heart of this chapter is a simple but powerful idea. Everyone makes financial choices based on their unique life experiences, not on objective facts. Housel starts by pointing out that no two people see money the same way because no two people have lived the same life. Your upbringing, the economic conditions you grew up in, and the financial lessons you've learned, they all shape how you think about money. This is why two people with the same amount of wealth can have completely different attitudes towards saving, spending, and investing. He gives an interesting example. Someone who grew up during a period of high inflation, when prices were constantly rising, will have a very different relationship with money compared to someone who grew up during a time of economic stability. The person who saw their savings lose value may be more inclined to invest aggressively, while the one who lived in stable times might feel safer keeping their money in cash. Neither approach is objectively right or wrong. They're just reflections of personal experience. One of the most striking points Housel makes is that your view of the world is a reflection of when and where you were born. If you were born in the 1970s, when inflation was out of control, you likely view rising prices as a constant threat. But if you grew up in the 2000s during a long bull market, you might think the stock market only goes up. These life experiences don't just shape your opinions, they shape your financial behaviors. Housel also emphasizes that people make financial decisions based on what they've personally lived through, not on facts or academic theories. You can present someone with all the historical data proving that the stock market rises over the long term. But if that person lived through the 2008 financial crisis and lost their savings, they may never trust the market again. It's not that they don't understand the numbers, it's that their emotional experience outweighs the facts. A powerful example Housel gives is how wealth inequality shapes financial attitudes. If you come from a wealthy family, you might see money as something to grow and invest because you've never worried about basic needs. But if you grew up poor, your priority may be safety, holding on to whatever you have and avoiding risk. These mindsets aren't just preferences, they're survival strategies based on real experiences. He also points out how people's financial goals differ widely based on their life circumstances. Someone nearing retirement is likely to prioritize preserving their wealth, while a young investor might be willing to take bigger risks for higher returns. Both are rational, but only when viewed through the lens of their individual situations. This is why judging other people's financial decisions without understanding their background is a mistake. One of the most compelling insights in this chapter is that many financial debates happen because people assume others see the world the same way they do, but they don't. For instance, an investor who survived multiple market crashes might call cryptocurrency reckless, while a tech-savvy millennial might see it as the future of finance. Both perspectives make perfect sense within their own experience, but they're totally incompatible. Housel also dives into how risk tolerance is deeply personal. He argues that how much risk you can emotionally handle depends not just on your age or income, but on what you've been through. Someone who's never experienced a financial loss may underestimate risk, while someone who's been burned before might avoid it altogether. Neither person is wrong, they're simply reacting to the lives they've lived. Another fascinating point he makes is that even within the same generation, experiences vary. Two people who grew up in the same decade can have radically different financial views based on whether they lived in a booming city or a struggling rural town. Your financial reality is shaped by the environment around you, and no two environments are exactly the same. Housel stresses that it's important to understand and respect these differences. Just because someone else's financial choices seem irrational to you doesn't mean they're actually irrational. They're simply responding to a reality that's different from yours. And recognizing this can make you more empathetic and less judgmental. He also touches on the danger of assuming your experience is universal. Many people fall into the trap of believing that what worked for them will work for everyone else. But Housel argues that financial advice isn't one size fits all. What's right for you may be completely wrong for someone living a different reality. One of the most practical takeaways from this chapter is that you need to design a financial plan that fits your unique life, not someone else's. Trying to copy another person's strategy without considering your own circumstances is a recipe for frustration. Instead, focus on what works for you, your goals, your risk tolerance, and your emotional comfort. Housel also highlights a key challenge. The world is constantly changing, but our financial behaviors are shaped by past experiences. This can lead to a disconnect. What worked in the past may not work in the future. Being aware of this bias helps you stay adaptable and open-minded. To illustrate this, he discusses how financial behaviors are often locked in by early experiences. If you grew up during a financial boom, you might always believe that risks pay off. But if your formative years were shaped by a recession, you may carry a lifelong fear of losing money. These emotional imprints are hard to shake, even when the world changes around you. At the core of this chapter is a simple truth. Your financial behavior is personal because your life experience is personal. No two people have the same story, which means no two people will see money the same way. Recognizing this helps you approach your own decisions with greater self-awareness and approach others' choices with greater compassion. Chapter 17, The Seduction of Pessimism, Morgan Housel dives into a fascinating truth. Pessimism is more seductive and convincing than optimism, especially when it comes to money. But while negative news grabs our attention, it often leads to short-sighted decisions that hurt long-term financial success. Housel starts by addressing a simple question. Why do pessimistic voices seem smarter and more credible? He explains that bad news feels urgent, while good news tends to be gradual and easy to overlook. When you hear about a financial crisis or a market crash, it demands your immediate attention. On the other hand, positive developments, like technological progress or long-term market growth, happen slowly, quietly, and are often ignored. Think about how the media works. Fear sells. Headlines predicting a market crash, economic collapse, or some financial disaster always spread faster than stories about steady growth or quiet success. Housel explains that this negativity bias isn't just in the news. It's hardwired into human psychology. Our ancestors needed to react quickly to threats for survival, so we're naturally more alert to bad news. And that instinct still influences how we think about money today. One of the most striking insights Housel shares is that losses feel more powerful than gains. Psychologists call this loss aversion. The idea that losing $100 hurts far more than gaining $100 feels good. This emotional imbalance makes us more likely to pay attention to pessimists who warn us of dangers rather than optimists who highlight opportunities. And when it comes to investing, this can be a costly mistake. Housel gives a compelling example from the financial world. Bear markets, when stock prices fall, are loud and terrifying. You'll see headlines screaming about lost trillions and the collapse of major companies. But bull markets, when prices rise, are quiet and gradual. Over decades, the market has consistently grown, but you rarely see headlines celebrating long-term compounding. He emphasizes that while pessimism sounds intellectually sophisticated, optimism is usually more realistic over time. This doesn't mean ignoring risks. It means understanding that despite setbacks, progress is the default state. Over the last century, humanity has faced world wars, depressions, oil shocks, and financial crises. Yet living standards have risen, economies have expanded, and markets have grown. Pessimism might sound smart, but optimism has historically been right. Another key point Housel makes is how pessimism often feels more actionable. When someone warns of a recession or a market crash, you feel like you need to do something. Sell your stocks, cut expenses, or move your money. Optimism, on the other hand, often means staying the course and trusting the process, which feels passive. And in a world where action feels like control, pessimism's urgency is hard to resist. He also explores why people who predict disaster are rarely held accountable when they're wrong. If a pessimist predicts a market crash and it doesn't happen, most people forget about the false alarm. But if they're right, they're seen as a genius. Optimists, on the other hand, don't get the same attention when they're right, because gradual progress isn't as dramatic as a sudden crisis. A fascinating section of this chapter breaks down how pessimism can distort your long-term financial decisions. When you're constantly bombarded with negative forecasts, it's easy to panic and make bad choices, like pulling out of the market during a downturn. But as Housel points out, the biggest rewards in investing come from patience and endurance. The people who panic when things look bleak often miss out on the massive gains that follow every market recovery. Housel also addresses a common misconception. Being optimistic doesn't mean being blind to risks. It means recognizing that while bad things happen, progress tends to outweigh setbacks over time. He argues that smart investors balance a healthy respect for risks with a belief in long-term growth. This balanced mindset helps you avoid being paralyzed by fear while still being cautious when necessary. One of the most eye-opening ideas in this chapter is that pessimism thrives on short-term thinking. If you focus only on the next year, the world can seem like a scary and unpredictable place. But if you zoom out and look at decades of history, a more optimistic story emerges, one of steady improvement and resilience. The problem is, our brains are wired to focus on what's happening right now, which gives pessimistic views a louder voice. Housel reinforces this point with a powerful example. If you only paid attention to news headlines over the years, you'd think the world is constantly on the brink of disaster. But if you look at long-term data, the stock market has returned over 10% annually on average for a century. That kind of steady compounding growth doesn't make headlines, but it's the reality. He also dives into how pessimism can create self-fulfilling prophecies. When people expect the worst, they often act in ways that cause problems. For example, if enough investors panic and sell their stocks, it can trigger a market decline, even if the economy is fundamentally strong. In this way, fear itself can become a danger. A critical lesson from this chapter is that pessimism is loud and immediate, but optimism is quiet and enduring. If you want to succeed financially, you need to resist the emotional pull of pessimistic predictions and focus on the bigger picture. It's not easy, especially when fear is everywhere, but it's how long-term wealth is built. Housel leaves readers with a clear takeaway. Being too focused on the voices of pessimism can cloud your judgment and prevent you from seeing the long-term opportunities that optimism reveals. While it's important to be cautious and aware of risks, you should also recognize that progress is the natural outcome of human effort and innovation. In Chapter 18, When You'll Believe Anything, Morgan Housel reveals a powerful truth about money. We don't make financial decisions based on facts alone. Instead, we are deeply influenced by the stories we tell ourselves and the narratives we believe. And here's the catch. These stories don't have to be true. They just have to feel true. Housel starts by explaining that humans are natural storytellers. We use stories to make sense of the world, especially when things are complex or uncertain. Money is no different. We tell ourselves stories about why the stock market will rise or fall, why real estate is a good investment, or why a particular business idea will succeed. These narratives shape how we think, feel, and act with our money. But here's where things get tricky. The more convincing the story, the more we believe it, even if the facts don't fully support it. For example, when the economy is booming, people create stories about why this time is different and why the good times will last forever. And when the market crashes, new stories emerge telling us that everything is broken and the future is doomed. Both extremes are rarely true, but the stories feel real in the moment. Housel emphasizes that when facts and stories conflict, people often believe the story. This is because stories appeal to our emotions, while facts engage our rational brain. And when it comes to money, emotions almost always win. This explains why intelligent people can make poor financial choices. They aren't lacking knowledge, they're trapped in a powerful narrative. A key point in this chapter is how financial markets thrive on storytelling. Every stock price reflects a story. Sometimes it's about future innovation. Other times it's about fear and collapse. These stories shape how investors behave. When a compelling story takes hold, people rush to invest, not because the numbers are solid, but because the narrative is too exciting to ignore. Housel gives a classic example, the dot-com bubble of the late 1990s. At that time, the dominant story was that the internet would change everything, and it did. But people took the narrative too far, believing every tech company was destined for massive success. As a result, investors poured billions into companies with no profits, no real business models, just a great story. When reality caught up, the bubble burst, and millions lost their savings. Why do these stories become so powerful? According to Housel, people believe stories that align with their personal experiences. If you grew up during a time of high inflation, you might believe that cash loses value and investing in physical assets like gold is the safest choice. On the other hand, if you became an investor during a long bull market, you might believe that stocks only go up, because that's what you've seen firsthand. This is why two people can look at the same financial data and reach completely different conclusions. Their personal stories, shaped by their background, upbringing, and emotional experiences, frame how they interpret the world. And once a story fits with our worldview, it's incredibly hard to change. Another powerful insight from this chapter is that people crave certainty, especially during uncertainty. When the future feels unpredictable, like during a recession or market crash, we cling to stories that promise clarity. Whether it's a prediction about the next big market boom or a warning about an impending collapse, these stories give us a sense of control, even if they're wrong. Housel also explains why some financial stories spread like wildfire. The most contagious narratives usually have three elements. 1. Simplicity. People love easy-to-understand explanations. 2. Emotion. Fear, greed, and hope drive financial decisions. 3. Identity. We believe stories that align with how we see ourselves. For example, the belief that homeownership is the American dream is a powerful story. It's simple, emotional, and connects with people's identity. Even when renting might be a smarter financial decision, this story pushes people to buy homes because it fits a broader narrative about success and stability. One of the most striking examples Housel shares is how stories drive financial bubbles. At the heart of every bubble, whether it's tulips in the 1600s, tech stocks in the 2000s, or cryptocurrency today, you'll find an irresistible story that people can't resist. When enough people believe the story, it becomes self-fulfilling until reality eventually breaks the illusion. And it's not just bubbles. Even our personal financial choices are shaped by stories. Think about it. Why do some people spend every dollar they earn while others save obsessively? It's not just math. It's the story they believe about money. For some, spending represents freedom and enjoyment. For others, saving represents security and peace of mind. Housel offers a practical takeaway. Be aware of the stories you believe about money and question them. Ask yourself, is this story based on facts, or is it just a narrative that feels true? Am I following this story because it aligns with my experience, or because it's actually wise? He warns that the most dangerous financial stories are the ones you don't even realize you're telling yourself. If you believe that smart people always beat the market, you might fall for expensive investment schemes. If you believe more money equals more happiness, you could spend your life chasing wealth while missing the things that truly matter. Housel delivers a clear message. Stories are powerful, but they aren't always true. If you want to make better financial decisions, you need to separate the facts from the fiction. Recognize that the narratives you believe about wealth, success, and risk are shaping your behavior, whether you realize it or not. In Chapter 19, All Together Now, Morgan Housel pulls together the core lessons from the book, offering a clear and practical understanding of how human behavior shapes financial outcomes. This chapter acts as a roadmap, tying together the ideas on wealth, greed, risk, and the emotional forces that drive financial decisions. Housel starts by reminding us of a fundamental truth. Managing money isn't just about knowing the numbers, it's about managing yourself. You could be a financial genius on paper, but if you can't control your emotions, stay patient, and understand your own behavior, you'll struggle to build and keep wealth. This idea forms the foundation of everything Housel has shared throughout the book. He emphasizes that wealth is more about how you behave than how smart you are. It doesn't matter if you can calculate complex market models or predict the next big trend. What matters is your ability to stay grounded, avoid impulsive decisions, and keep your long-term perspective intact. One of the most powerful insights Housel shares is this. Financial success is less about talent and more about choices and habits. Simple behaviors, like saving consistently, being cautious with risk, and staying patient, can have a greater impact on your wealth than any fancy investment strategy. He brings back the idea that luck and risk are two sides of the same coin. No matter how careful you are, you can't control everything. Sometimes, people who make all the right moves still face financial setbacks. And other times, people who make reckless decisions get lucky and strike gold. This uncertainty is why humility is key. Never assume you have all the answers or that your success is purely the result of your intelligence. Housel stresses the importance of saving money, not just to grow rich, but to buy freedom. The real value of wealth isn't just about having a big bank account. It's about having control over your time and choices. Money gives you the ability to walk away from things you don't like, to spend time with the people you care about, and to make decisions without constantly worrying about financial survival. He also reminds us that the most powerful force in building wealth is compounding. But compounding only works if you give it time. You don't need to chase quick gains or take extreme risks. Instead, focus on staying in the game for the long haul. Small, consistent decisions, like saving a portion of your income and letting your investments grow, can lead to massive outcomes over time. Another key takeaway is that enough is a powerful word. Chasing more money without defining what enough means for you leads to endless dissatisfaction. Housel points out that there's no upper limit to greed. If you're always trying to keep up with someone richer, you'll never feel satisfied. Understanding what enough looks like for your life helps you step off the treadmill of endless ambition. Housel revisits the idea of room for error, building a margin of safety into your financial life. Life is unpredictable, and even the best plans can go off track. This is why having a financial cushion, extra savings, diversified investments, and a mindset of caution helps you survive when things don't go as expected. One of the most human insights from this chapter is that your financial goals will change over time. What feels important today might not matter a decade from now. This is why it's crucial to stay flexible and open to adjusting your plans. Don't lock yourself into a rigid definition of success. Give yourself the space to evolve. Housel also addresses the seduction of pessimism, why negative financial stories sound smarter and more realistic than positive ones. But he reminds us that the world tends to get better over time, despite setbacks. While it's easy to be swayed by doomsday predictions, history shows that progress is the long-term trend, even if the road is bumpy. Another crucial lesson is that people's financial decisions are shaped by their unique experiences. Two people with the same information can come to completely different conclusions based on their backgrounds. This is why there's no one-size-fits-all approach to money. What works for someone else might not be right for you, and vice versa. Housel emphasizes that every financial decision has a cost, even if you can't see it immediately. Whether it's the emotional toll of staying disciplined during market downturns, the sacrifice of saving instead of spending, or the patience required for long-term growth, nothing is free. Success requires accepting and paying these hidden costs. He also reminds us to be mindful of the stories we tell ourselves about money. People believe what feels emotionally true, even if it's not factually accurate. Recognizing how narratives influence your decisions allows you to separate reality from illusion and make better choices. Ultimately, Housel boils down financial wisdom to a simple truth. Being wealthy isn't about being the smartest person in the room. It's about being the most patient, humble, and disciplined. The ability to avoid short-term temptations, embrace uncertainty, and stay the course is what leads to lasting success. Chapter 20, Confessions, Morgan Housel shifts gears from broad financial principles to something deeply personal, his own beliefs and behaviors about money. This chapter gives us a candid look into how he handles his finances, the mindset he maintains, and the lessons he's learned along the way. It's not about giving a universal blueprint. It's about showing that financial decisions are personal and shaped by unique experiences. Housel starts by admitting that his financial philosophy is simple. He wants to live a life where he doesn't need to worry about money. For him, that doesn't mean chasing extraordinary wealth or constantly trying to maximize returns. It means having enough financial security to avoid stress and gain freedom over his time. This mindset reflects one of the book's core lessons. Money's greatest value is giving you control over your life. He confesses that he saves a significant portion of his income, not because he's aiming to become as rich as possible, but because he values freedom. Housel doesn't view saving as a means to buy luxuries. Instead, it's about buying options. This is a powerful perspective. He's not just saving for retirement or emergencies, he's saving to ensure he has the freedom to make choices that align with his life goals. One of the most honest admissions he makes is that he's not trying to beat the market. Despite his deep understanding of finance, Housel follows a simple passive investment strategy. He puts most of his money into low-cost index funds and lets time and compound interest do their work. This approach reflects another lesson from earlier chapters. You don't need to chase complexity to build wealth. Simple, patient strategies are often the most effective. Housel also shares that he and his wife have no debt. Not because debt is inherently bad, but because they prefer the emotional comfort of being debt-free. This decision is rooted in their personal values. It might not be the optimal financial choice according to some experts, but for them, it provides peace of mind. And that's the point. Personal finance is personal. What works best on paper isn't always what feels right emotionally. A striking point he makes is he's willing to leave potential returns on the table to maintain peace of mind. Housel isn't obsessed with squeezing every last dollar out of his investments. Instead, he prioritizes stability and the ability to sleep well at night. This reflects a key theme throughout the book: reasonable beats rational. It's better to make decisions that fit your life, even if they're not mathematically perfect. He also acknowledges that he values independence over luxury. While many people see wealth as a way to buy bigger houses or fancier cars, Housel sees it as a tool to buy autonomy. He doesn't want to be tied down by obligations or feel pressured to maintain a particular lifestyle. This echoes the man-in-the-car paradox. Wealth shouldn't be about impressing others. It should be about creating a life that reflects what you truly value. Interestingly, Housel reveals that he's happy being a little underinvested. He could take on more risk and chase higher returns, but he doesn't because his current strategy gives him everything he wants: freedom, security, and a comfortable life. This confession reinforces the idea that enough is a powerful word. Once you know what's enough for you, you stop chasing more for its own sake. Another important confession: he's not trying to time the market. He doesn't attempt to predict recessions, booms, or crashes. Instead, he sticks to a consistent plan. This aligns with one of the strongest themes in the book: time in the market beats timing the market. Trying to outsmart the system is a risky game, and for Housel, the safest bet is staying the course. Housel also mentions that he's careful about lifestyle inflation. Just because he earns more doesn't mean he spends more. He intentionally keeps his lifestyle simple and avoids falling into the trap of upgrading everything as his income grows. This fits perfectly with his belief that true wealth is what you don't see. It's not about flashy displays, but about having the quiet confidence of financial independence. He admits that he and his wife prioritize experiences over things. Instead of chasing material possessions, they spend money on things that create lasting memories: travel, time with family, and experiences that enrich their lives. This ties back to his core philosophy. Money is a tool to create a life you love, not to impress other people. One of the most humble reflections he offers is that his financial beliefs are shaped by his personal experiences. He doesn't claim to have universal answers. What works for him may not work for everyone, and that's okay. Throughout the book, he's emphasized that our financial choices are shaped by where we come from, and he applies that same understanding to his own life. At the heart of this chapter is a profound realization. Money is about living life on your own terms. For Housel, that means avoiding stress, maintaining flexibility, and protecting his independence. He's not chasing some external definition of success. He's defining it for himself. His final confession? He knows his financial plan will evolve. Life changes, and so do financial priorities. He stays open to adjusting his strategy as his needs shift. This is a reminder that rigidity is the enemy of long-term success. Being adaptable is what allows you to thrive through life's uncertainties. His message is clear. Understand what you truly value, prioritize peace of mind, and let your financial decisions reflect the life you want to live. And that brings us to the end of The Psychology of Money by Morgan Housel. This book isn't just about numbers. It's about how your mindset, emotions, and behaviors shape your financial future. From understanding the power of saving to recognizing the role of luck and risk, these lessons can completely transform the way you think about money. The insights from this book are not just theories. They're practical tools you can use to take control of your financial life. If you found these lessons helpful, make sure to like, share, and subscribe for more deep dives into life-changing books. Your support means a lot and helps us bring you even more valuable content. Thanks for watching, and I'll see you in the next one.